Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So in this video, we're going to learn how to turn a penny into $5,300 and some change without making more income using a strategy called velocity banking. So as you can see here, we have $9,644.49, and we have expenses in $9,644.48 with 10 credit cards, right? A mortgage and other general expenses. And so anybody can do this. It's so easy that you can do this at home too. If you can just make a budget and just do basic third grade math. And I'll tell you who's unlikely to be able to do this, right? Probably the people in the state of California. So I was watching this YouTube video about how audit reveals California did not track outcome of billions spent on homelessness. And it's funny because like they just spent billions and they probably I don't know if they even tracked it on a spreadsheet like this, but it's like where'd it go? Where'd it go? Did we solve the problem? No, who cares? And you know what's really funny in life? This is just kind of random side tangent, but it seems like when you make like little mistakes, people are so critical of you. But when you make big mistakes, and I'm talking about mistakes to the nth degree, like spending billions and not knowing where it went, like people don't criticize you. It's like, well, oh, well, let's just ignore that. Oh, you made a math error in velocity banking. Oh my goodness, let's criticize you to death, right? It's kind of funny how that works. But back to my point here. So basically, this is so simple that everybody can do it, except for probably people in California state government. Anyways, so we make two assumptions, right? So we assume that we have the exact same income, and unlike Dave Ramsey, who says, "Oh man, you should have like $1,000 in savings," I don't know how in this situation we're going to save $1,000. Do you? Like, I know that every time we make a credit card payment, like this goes up a little bit because the credit card payments go down a little bit. But it's like, how long do I have to wait to save $1,000? It might even be years. I don't know. I got to do the calculations one time just to verify like what happens after every single month, and then once we get to 1,000, that'll be crazy. Right. So if you ever wanted to figure out like what the minimum payments of a calculator or I mean a credit card are, you can use the bank rate website, minimum payment calculator. Now, every credit card is different, so you have to go ahead and call your lender and ask him how the payment is calculated. It's usually like a percentage of something or a minimum of like, oh, $45 or a percentage plus interest, whatever is higher or something like that, right? So all you got to do is just put in the balance here. So it was $5,000, 5,000, and then just put in like the interest rate. So let's say 30%, and then they'll give you this minimum payment right here. So 175. So if we take a look here, you see this 175, and so you know that you can actually calculate or make your own velocity banking spreadsheet or examples just to practice on. And all of this is just practice, right? I just do this like a million times, and that's how I know this out the back of my head. Okay, so basically, in order to do velocity banking, you just need two things. Number one is a budget, which we have. Make sure in your budget you have every single debt that you have that's on your that you have to pay, because velocity banking is a debt attack plan. If you don't have any debt, you don't need velocity banking. Like, what are you here for? And if you make like $9,000 of income and you have absolutely no debt and you have $9,000 expenses, that's not velocity banking is not going to help you because it's a debt attack plan, right? So this is what we're going to do. We're going to do the exact opposite of what Dave Ramsey teaches us, which is instead of one penny of savings, oh my gosh, we're going to go to 0 penny of savings, and we're going to somehow turn this penny to 5,300 and some change, right? And let's go to step two. So step two is we're going to make our line of credit as our main operating account, a line of credit. So if you don't know what a line of credit is, all it is basically a financial tool where you can borrow money, pay it back, and then use it over and over again. So there's three types of lines of credit that I'm aware of, or maybe four. One is a personal, so it's just in your name. One is a home equity, so it's kind of like a personal, but you're putting your home equity as collateral. There's a business line of credit, so if you're doing your business, you can do that. And then there's credit cards, right? So credit cards is a line of credit because you can use it, pay it back, and kind of rinse and repeat over and over again. But credit cards is kind of a method that you don't want to use as your main tool. You kind of want to use as your secondary tool. I won't go into it too much, but let's assume that we have a home equity line of credit, and all home equity is like the value of your home minus any of the debts that you have, right? So let's just assume because we're a homeowner, we got lucky and we have a home equity line of credit for $200,000 for us to use. And let me take this out. Sorry. So like a $200,000 credit card based on the value of your home. But the cool thing about this is you can use it to pay anything, right? Like normally it's hard to pay credit cards with like mortgages and stuff like that. And you can do it with Plastique, but I actually looked at Plastique's website, and you not every card allows you to do this. They have actual restrictions like Amex, you can't do it. I think Discover, no, Visa you can't do. Amex and Visa are the two big ones. As far as I'm aware, you can't even pay a credit card with a loan, but Discover and MasterCard, I think you can, but you should go ahead and check. So here, okay, we're going to assume that we have a $200,000 home equity line of credit available. Now, some people think, oh man, this is kind of unrealistic because who has a $200,000 home equity line of credit available? And this is why we have to understand credit, right? We have to understand credit because most people think of like banks and credit kind of like to think of food and restaurants. Like, okay, I'm going to go to a restaurant because I'm hungry. That's the reason why I go to a restaurant. When it comes to banks and lending, it's the exact opposite. Banks don't lend money to people who need it. So you have to make sure you get the credit before you ever need it. In fact, I recently got 8,800, I think, no, 8,500 in additional credit just yesterday because I didn't need it. They're just like, hey, here you go. And I was like, okay, cool. I got a $7,500 business credit card, and I have a $1,000 increase in one of my credit limits for one of my small cards. And I was just like, sure, because I don't need it, right? Same thing with I'm sorry, it's the opposite with what we normally do with restaurants. It would be kind of weird if we went to a restaurant because we are not hungry. That'll be like the weirdest thing, right? But when it comes to banks, you have to think that way. And this is why credit is very unintuitive for the average person, right? Because banks don't lend money to people who need it, right? And in fact, let me just kind of go on a quick rant or example here. Apple Card, regret, Goldman Sachs, right? So if you don't know anything about the Apple Card, it was started with a partnership by Goldman Sachs and Apple, and these two entities don't have experience in consumer lending, and so basically the partnership cost them hundreds of millions of dollars. With one executive report saying we should have never done this effing thing. Why is it that they failed? Well, I'll tell you one of the reasons why they failed. They didn't have underwriting standards like traditional consumer lenders do, as far as I'm aware, right? And so, again, if you lend money to people who need it, you're going to be like Goldman Sachs and the Apple Card, in my opinion. Like like you literally lending money to people who need it is going to cost you money. This is why this is how you make money as a lender. You lend to people who don't need it. Very unintuitive for the average American, right? So let's just go ahead and do this. So what I want to demonstrate is even if you had a $200,000 home equity line of credit, there's still a difference between using it between the average American and Velocity Banking. So what's the difference between the average American and the Velocity Banker? Well, the average American uses their checking account as their main operating account, right? You paycheck comes in, you pay for things in your checking account, whereas Velocity Bankers, we use our line of credit as our main operating account. And so even if you have this $200,000 home equity line of credit, let's say we had to borrow $1,000, right? Or maybe we'll just say 2,000. Okay, 2,000 at 10%. Now, if we are here and we say, "Oh my goodness, we need an extra $2,000 because my car is broken down," right? Let's just do this. Put this and do $2,000, and let's go to 10%. Then by next month, our minimum payment's going to be $36. Okay, and I know that's not that much, but when you're in a pinch like this, and I'm just going to add 36, right? $36, we're in negative cash flow savings territory. That's a no bueno, right? So that's what I mean. It's not just having a home equity line of credit and using it as a reserve, it's using it as your main operating account. Totally big difference. And it's very nuanced, but incredibly big difference. So here we are with our original situation, and let me go ahead and erase this right here. Now let's go ahead and do this. and I'm going to go ahead and copy these, debts, and we'll see how velocity banking differs. So the actual strategy is your entire paycheck into that line of credit, right? And then your expenses out, and you rinse and repeat over and over again, and you're going to maximize this number called cash flow, C2 minus C3, right? And so this cash flow number is going to be very similar to our savings in the beginning until we go ahead and move some debt into our line of credit as our main operating account. So we're 90% there, but we haven't started yet. But let's do this. Let's move these 10 credit cards. 10 credit cards. So if you sum these all up, these 10 credit cards up, I've already done the math for you. That's $167,000 of debt, right? $167,000. Let's go ahead and move this $167,000 of debt here. And then what happens to all these payments? Oh my gosh, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, right? And somehow this penny became $5,345 and some change. And I did not make more money. See the genius of this strategy? Like people freak out about like credit card debt, and that's the easiest problem to solve with velocity banking. So, in fact, if we put this entire paycheck into a line of credit, the reason why the payment doesn't necessarily affect us is because that payment is satisfied when you dump that entire 9,000 or 9,600. And the next thing that we have to be aware of is it minimizes the interest because dumping the entire paycheck is going to skew the average daily balance, right? So we're not going to pay as much interest. And one other thing, if you want to really minimize the interest, use credit cards, okay? You can use all these 10 credit cards up to this $2,500 limit. Because what's the beauty of credit cards? They don't accrue interest if you pay them off in full at the very last moment before that statement. If you pay off the statement balance before the next statement comes out, right? So if you want to possibly delay the interest by a month, use all these credit cards. You could use all 10 of them up to $2,500, and you might get some bonus points, rewards, travel points. Who knows, right? And so let's go ahead and actually calculate this. So we're gonna do our calculation, and again, our calculation is the previous month's balance plus the previous month's interest minus our cash flow number. So here we were struggling with this one little penny, and then I get it. This little penny will actually go up, once we make our minimums by probably a couple of dollars or something like that. And then here we're $1,000 emergency in the first month or 2,000. Well, who cares? We're okay. We can go to sleep at night. You see the difference? When I used the line of credit as my backup, this goes to negative cash flow. When I use my line of credit as my main operating account, I basically I created cash flow out of thin air, like a penny into $5,345. It's a clickbait title, but listen, I'm doing the math. I'm showing you on the spreadsheet, unlike the state of California where they just throw billions and stuff's like, where'd it go? And nobody really cares. That's the sad part, which is why I love California. Political comment, but there's a saying that if you don't care about politics, politics will care about you. You know what I'm saying? All right, so now let's go ahead and calculate this, where we take the previous month's balance plus the previous month's interest. And I know this interest is empty, but that's because when you move it in the very first month, it's going to be empty, right? Because the interest doesn't calculate until 1 month passing. But even if you don't have this number, it's still a good estimate, and it's an easy copy and paste formula. So here we have $5,345.84, 5345.84, right? And that's our cash flow number. And then we go ahead and take that average daily balance, because that's how the interest is calculated. If you don't understand how this works, again, this is just an estimate, right? Your average daily balance is going to be based on when you deposit your paycheck and what the actual averages is. And there's, I might go over that in more detail in another video, but you can use this formula to estimate average multiplied by the interest rate. So 0.1, 10% right here, and then you divide by 12 to kind of get the monthly interest. Although technically they do it by the number of days in the month, but it will give you a similar, what's it called? A very good estimate. So now that we have our three formulas, okay, now we just do copy and paste, right? We do copy and paste, and then we scroll down until we see red numbers, right? We just see red numbers. That means that entire thing is paid off, right? So at month 37, this is paid off, right? Month 37. Okay. So now we just type in our milestones that all of this debt was completely paid off in 37 months. And how much was that? That was 167,000 of credit card debt. Okay. 167,000 of credit card debt. Now, that $167,000 credit card debt is paid, guess what? We only have the mortgage left as our final debt, and we can do one of two things, right? If we have $5,345.84, we can put our entire this would just go to our savings, right? If we're not applying to any other debt, and then put this $5,345.84 into that mortgage directly. But I'm going to tell you something. Statistically, almost nobody will do that because most people are afraid to put all of their entire money in their savings into a loan because a loan is a one-way street. This is why they get you with those income-based repayment plans for, like, especially for student loans. People are afraid to dump money into a loan because it's a one-way street, right? And if they need it for emergencies, they get scared, and then if they use a credit card for a backup, then they're like confused, like, okay, where does my money go? Does it go to the credit card? Does it go to a loan? So what we want to do is make it so easy for you to pay this thing off quickly that we just move this parts of it into a line of credit. Now, I'm not going to go over the math with you, but luckily we have a Velocity Banking calculator, right, to kind of do the math for us, provided by Renatus, because this is where I first learned Velocity Banking from. And full disclosure, I make money commission selling this as an independent contracted marketer. So I heavily promote Renatus products because this is where I learned Velocity Banking from in 2017. I paid about $2,000 for it, right? And then, once I learned it, I got my first home. And then after 1 year, I paid off 25% of my mortgage. I was like amazed, like, wow, nobody else does this because they're just making the monthly payments. And if you ever look at a loan amortization schedule, it's crazy, right? So what we're going to do is, let's say, move this. First of all, we got to figure out what the mortgage balance is at 37 months, right? So what we could do is go to calculator.net loan amortization. And then I know I'm going a little bit fast, but if just pause the video if I'm going too fast, right? So I just go right here, and then I just put in the numbers. So for this one, it's going to be 300,000 at 30 years. Oopsie, 30 years at 6%. And I'm going to calculate this. And so you can see this monthly payment of $1,800. But take a look at this. This is the crazy part that I never knew about mortgages until I learned about Velocity Banking, because I didn't qualify for a mortgage when I first learned it. It's after 30 years, you pay double, more than double. So you got a loan for $300,000. Well, guess what? You pay $347,000 in interest, right? People don't know that. It's like, whoa, like I'm paying like double for a house, kind of. Is that crazy? I didn't know that. Okay, so now let's go back here. So let's figure out what the balance of the loan is after 37 months, and it's not going to be that much. So 37 months right here. So we're at 287, right? 287. So let me just go back here. And so in general, there's certain things we have to consider that we haven't really gone over. We have to consider debt payoff in order to maximize this cash flow number. Usually when you pay off the mortgage first, this doesn't provide enough cash flow in order to pay off your debt quickly, which is why we leave the mortgage last, right? Like you don't want to pay $300,000 just to get $1,800 back, right? So now we are 287 right now. And let's think about this. How long does it take to go from 287 to 277K if we're just following the bank schedule? And remember, the average American usually does not overpay loans because of that one-way factor and the fear that, hey, if something happens to me and I need that money, oh my goodness, what do I do? And then, oh my goodness, I don't want to put on a credit card because XYZ, right? That's kind of how they think. So let's just go here, 277,000. So let's say we start here. How long does it take? 1 year, 2 years, 2 years and 3 months. Okay, 2 years and 3 months. And let me just show you the principle of using your line of credit to pay it off. Basically, let's move $10,000 here. So plus 10,000, and then we paid it off in 2 months. So something that was going to take us 2 years and 3 months, and we pay all that interest, just move it to your line of credit. It's almost going to be the same thing. And plus, you prevent something, and this is really important. This is a philosophical principle that I'll go over in another video, which I have gone over in other videos, something called segregation of income, right? Segregation of income. They say that segregation is legal. We need to make segregation of income illegal because that's how the banks make their money. And what do you mean by that? Well, think about this. The reason why banks and make their money is because you nobody really starts out with debt, right? But what happens is that you get one loan or credit card. Oh, that's not that much in a payment, and then you get another loan or credit card. Oh, you get a savings account. Oh, you get a 401k, and then you have all these accounts, and then your paycheck comes in, and it gets split over the wazoo. So how effective is it going to be when you have to split your money up the wazoo? It's not going to be that effective. That's a very philosophical principle that velocity banking essentially espouses, that we're going to prevent segregation of income. Okay, so now if you want to see how long it takes to pay this off, so what we do is just use our velocity banking calculator here. So all you gotta do is just put it in here, and then 300,000, and right here, and 6% interest rate, 30 years, and then what's the payment amount? It's 179865. I know I'm going a little fast, but again, this is only for Renata students. So if you're not a Renata student, you get access to the calculator, and then we'll just put in our income here. We'll do this, and our expenses, everything except for the loan we're trying to pay off. So 2,500 here, and again, the interest rate doesn't matter that much compared to our cash flow number. So let's just move, let's say, $10,000 to that line of credit, and then use our cash flow to pay it off. And let's just say it's a 10% line of credit. So let me just do this. So 3.8 years and $35,000 of interest. Now, some people think, oh my goodness, let's put our entire loan into line of credit, and you're going to see that's bad news. So let me just show you why. So 3.8 years and 35,000, 4.2 years and 66,000, right? So we save interest, but it's like we paid double and it took longer. And that's what happens when you move a lower interest rate loan to higher interest rate line of credit. Whereas if you just kind of do it incrementally, or they call it quote chunking, it's gonna be better, right? A better situation. 3.8 years and 35. Now, if for whatever reason you find it advantageous to even do it with a credit card, now I'm not saying that interest rate doesn't matter. It does matter, but it doesn't matter as much as you think. I do 30%. Look at that, 3.9 years and 40,000. So if you have like a credit card that has insane rewards and allows you're using the service like Pastique or whatever that allows you to pay it, and the points offset the cost of using that credit card more than $2,000, why don't you use it, right? Maybe. Or is it, hold on, let me go back. Oh, that was $5,000, my bad. So $5,000 and offsets it, maybe. And if it doesn't make sense, then, one of the ways that you can kind of see it is as a credit building exercise, because they give you a lot of credit if you tend to use it. And there's a saying that I remember from our classes, is that the best credit decision is not necessarily the best financial decision, right? At least in the short term. So if you want to build credit, yeah, use it. Maybe have your lender get a little bit of money, but don't give them too much money. I mean, don't give them $252,000. And the beauty of credit is that it really helps you manage your cash flow in case of emergency expenses. So, for example, if you have a rental property, it's very common that people think, oh, I'm cash flowing, and then, oh my goodness, the HVAC went out, and now you're like out like 5 to 10 grand, right? But if you have lots of credit, and big companies like Walmart buy things on credit, not in the same way that we necessarily do, but it helps you manage your cash flow a lot easier if you build credit. So if you were willing to give the lender, a few grand more, then they'll likely extend your credit, because they want you to get to a point where they give you so much and then they make you drown. That's the honest truth, right? They want, like, if you're, think about it, if you're a millionaire and I'm a lender and I give you a $10,000 credit card, right? I give you a $10,000 credit card and you always consistently pay it off with no interest. I'm going to raise that limit up to the point where I think I don't need to give you anymore because you're going to finally get to a point where you don't pay me off in full, right? That's how I would think as a lender. But my point is that even if you use a 30% credit card, yeah, I mean, it's more interest, but not that more interest. And if you do, you compare it to like putting the entire thing in the line of credit, right? At a 10%. Okay. All right. So this is a Korean Atlanta mentorship. Again, another clickbait title that's actually reproducible, unlike the state of California. So we turned a penny into $5,345.84. In fact, let me just see how long this took. So 3.8 years, right? So 3.8. So let's just do this. 37 divided by 12 plus 3.8, right? And that's 6.88 years. And how much debt is that? So that's 467K of debt paid off. Oh my goodness. Right? So now this will go to zero. And now we're at $7,144. Now, let me go put this back. Now, on day one, we're at $5,345. But after 6.88 years, then we got what I call rich people problems. And what are rich people problems? You have money in your savings account and you feel like you got to invest because you don't want to lose out to inflation. But we'll talk about that later time. All right. Well, have a great day, everybody. And we will speak next time. This is Korean Atlanta Mentorship, and I'll see you again.